Now let's get on to look at some of the background. Let's give a bit of background to where we're going with this conversation with what you call the Tinubunomics on inauguration. For the markets, let's go to that because this all out about what the new president said in his speech. This is a trading day, by the way. We'll get to this a little bit later. Just to give you, harvest a few of the numbers for you to show, give you a sense of what the first day of the Nigeria's new president looks like on the market. On the equity side, on the NESE over-the-counter market side, this is your open market paper maturing 26th of December. That's 4.5%, 115.4 billion. That's at the FMDQ. That's the biggest size. One single there. Transaction today from that particular bill maturing 26th of December this year. So that's investors taking that up. That's a discount high. Now you've got a Eurobond 2029, $88, 11.78%. This figure went better to 13% at about 3 p.m. Nigerian time. Investors were really, really happy about Nigeria's transition. So the market is binging on that. I spoke about the overnight note. That's the commercial rate lending. Overnight among commercial banks, they got $464.50 for the dollar. So just in summary, you know what the trading day looks like for the first day. We're going to track this for tomorrow, the second trading day. So this was part of what the new president said in his speech at the inauguration. We call that Tinubunomics. This is how it all moves on. Broadly speaking, full subsidy, commodity bulls, higher GDP target, budgetary reform, industrial policy for manufacturing. He spoke about redirecting full subsidy. Then you got all about monetary policy, interest rates, exchange rate, Naira swap to be reviewed, and of course, old and new Naira notes to coexist, focus on infrastructure to create jobs, plans to double electricity, generation, anti-investment, review of the tax laws. It's all about in the new president's speech. However, the dinner that was held before that on Saturday had Nigerian-born president of the AfDB, Dr. Adesina, giving his own speech about what he expects President Bola Ahmed Tinubu to focus on as the Nigeria's new henchman. He says Nigeria is looking to the new president with hope. And he says the hope is to improve the state of the economy and the new wave of prosperity. The AfDB president additionally advised the new president to focus on how to change Nigeria's revenue from paying debt to that of growing the economy. And the way to start is by removing what he calls the inefficient fuel subsidies. The AfDB president went on to advise Bola Ahmed Tinubu, the president now in office, to take a very good look at urgent need to cut the cost of governance and to rely on private sector for infrastructure, financing, and of course fix Nigeria's macroeconomic and fiscal stability. There's a whole lot more about how tax is spent, not how much is made, and what are the deliverables. So let's continue to look at this conversation. Now let's chat now to today's trading day and the outlook on Tinubunomics for the markets. Licensed dealer and CEO at Career Asset Management, Johnson Chukwu. Good evening. Good to have you this evening. And itself, congratulations. We've got ourselves a new president now. So let's start from the market because that's where you belong. Let's look at the trading day across equities, over-the-counter, fixed income. What's your reading of today's trading day on markets? You've seen the numbers.
Yes, Bosim, first of all, thank you for having me. And I would say that the numbers were not strange to me. This morning, I had a meeting with my staff and we discussed extensively on what the outlook should be based on the president's inaugural speech. And one of the things we have actually predicted had begun to happen. I predicted that we should see a rally in the equities market. Of course, if you look at that address, you recall that the president said that he took out a subsidy on petroleum product, which is an inefficiency all of us have been complaining about. And then he talked about driving a policy that will reduce interest rates, reviewing the monetary policies, the current monetary policy stance, improving productivity, improving power generation, and harmonizing exchange rate. But what resonated most to business operators is one, taking out the subsidy on petroleum products, two, harmonizing exchange rate, and three, driving down interest rates. And I have actually cried myself hugs. I think I was on your program earlier last week, and I said, look, the concept of a continuous increase in monetary policy rate from a low of 11.5% to 18.5% has not in any way been able to curtail inflation. And that what is doing is that we're stifling private sector productive activities. So anybody has come up to say, look, the president coming up to say, look, we're not going to continue that trajectory. Sends a message to equity investors that, look, well, it's time to underweight your portfolios in fixed income and overweight them in equities, because equity investment is actually the productive sector of the economy. So that is what drove the rallies we saw in the equity space. On the rallies in the Eurobond space, the harmonization of the exchange rate means that foreign investors will be more interested in Nigerian instruments. But most importantly, removing the subsidy will mean that our demand for foreign exchange for importation of petroleum products will decline, and then we will have some stability in our foreign exchange management. So those are the factors that excited market operators, both local and foreign investors. The rallies you saw in the equities market, I don't think was solely that of local operators, particularly if you consider the fact there was also rally in the bond market, particularly Euro bond market space.
Yeah, across we also saw average benchmark yield on Naira bonds today, well, about 3 basis points to the upside. Treasury bills, look at that very single-day transaction. Yield about 10 basis points higher. Average T-bills today at about 6.85%. Yields declined. Again, when you look at this, put all this together, what does he say? Because I'm sure the new president spoke about interest rates, inflation, and all of that. So what's the word on the street among you market professionals and dealers since inauguration on Monday? Yes. What's the word on the street, John?
Yes. Yeah, for us, we have come to realize that the new focus of the government would be that the emphasis will be on driving productive activity, driving economic growth, driving job creation and employment, instead of focusing entirely on fighting inflation. So if the focus is shifted away from fighting inflation and focusing on productive activities, and then the government is going to drive down interest rates. So clearly, those who are holding short-dated instruments like treasury bills that want to sell can easily sell and make capital gain, because investors will know that they cannot get the higher yields, so they are ready to buy those instruments at even lower yield. Today, that's why you saw the moderation in local currency debt instruments and as well as treasury bills yield. And I think that is likely going to continue on, even while people are waiting for more clarity on how the government wants to go about that. But he talked about monetary policy management, which is an area some of us had picked the whole issues with the central bank, the way monetary policy have been managed. You can't manage monetary policy in isolation of the economy. And our take is that for an economy that has a 33% unemployment rate, an economy that was at best grew at about 2% in the first quarter of this year, the emphasis should be that we should drive economic growth and not just fighting inflation. And if you recall, I've always said this, that the inflationary pressure we're facing today is not driven by expansionary credit policies. It's largely, if there's any expansion in credit, it's central bank granted credit to the federal government, but not commercial credit. So you can't fight it by contracting monetary policies, and it has not worked. So now that somebody is going to look at it again and say, look, let's even look at this approach we have adopted. Has it worked? Do we have a better approach to managing our macroeconomic parameters? Inflation rate, interest rate, exchange rate, and I think the president touched on most of those critical parameters.
Yes,
he talked about interest rate.
Yes, Johnson, he touched on those critical parameters, and he spoke about this house cleansing of monetary policy. What do you think of type of reform do you think Tinubu had in mind when he talked about house cleansing of monetary policy? I haven't heard that phrase in such a long time when you say house cleaning. What do you think he has in mind? How would it impact the markets?
Well, boss, it would be difficult for me to hazard a guess into what went on, what was in his mind. But there are issues that we have with the monetary policy management. One, starting from the issue of multiplicity of exchange rates. I mean, I'm not just me. You have said it repeatedly, and several other opinion leaders in the economic space have said that we should not continue with multiple exchange rates, because embedded in multiple exchange rates is subsidy to those who are well connected in the society, because they get the FX allocation at rates that are sub-market rate, well as the rest of us get at the market rate. So that's one factor that you can consider may be part of the house cleaning they're talking of. We know that the monetary policy, the monetary authorities have granted unlimited access create access to the federal government in terms of ways and means. You can also call that some form of cleansing of the housekeeping of the monetary policy, because you really can't continue to grant accommodation to the federal government without abiding by the Fiscal Responsibility Act as well as the CBN Act. Those are breaches of extant laws and regulations of the country. And then we've talked about I've talked about the issue of continuous increase in monetary policy rates. We've seen a monetary policy rate increase by about 700 basis points from 11.5% to 18.5%. We've seen a 500 basis point increase in cash reserve ratio. And still, when we started these rate increases, inflation rate was about 15%. Today, we're talking about 22.2% inflation rate, which shows that these measures have not succeeded in fighting inflation. What has it done? It has actually stifled private sector access to capital that is required for productive activities.
Do you think fiscal policies also need house cleansing?
Well, if you recall, I've always said that the fiscal policy of the government has been in doldrum for the past 8 years. We really can't see clear fiscal policy direction. So it's not just, I wouldn't use the word cleansing. I would say it needs to be reactivated and brought alive. The fiscal policy, some of the spaces that the monetary policy has dabbled into, we are that of the fiscal authorities. But because, like I always say, that the nature of Apple's vacuum, seeing the fiscal authorities seem to have been on holidays, the monetary authorities have begun to overreach themselves to play the roles of the fiscal authorities. So we need a vibrant fiscal authority. We need a vibrant use, effective use of budgetary tools as instrument for economic development. We didn't see so much of that. We need to use the budgetary budget as instrument for job creation, as instrument for focusing on some sectors of the economy we think we have competitive advantage for development. We need to use that as tools for attracting foreign direct capital into the country. I don't think we saw so much of that in the past couple of years.
Well, the inaugural address touched on high interest rates, which the new president described as too high. So how could a lower rate market be achieved? Is it a short, medium to long term? How do you think a lower interest rate regime could be enthroned?
Well, ideally, interest rates should mirror the inflation rate. But sometimes you have that disconnect, particularly where the factor that drove interest rate, inflation rate is not monetary in nature. So in terms of driving down in interest rate, the first thing you have to start is the issue of the monetary policy rate. In as much as I said there's no alignment between monetary policy rate and inflation rate. So, but given that inflation is currently driven by lack of productivity, particularly agricultural productive activities, once we address the issue of infrastructure, security around the major food belts of the country, you will begin to have some control or handle over inflation. So you really know that issue of interest rate is a matter of the price of money. And because that alignment is disconnected, so your emphasis should be, how do we improve productivity? Remember also that another factor you have to bear in mind that increase in productivity is the surest way to fight inflation. So how do we improve productivity so that ultimately the gap between interest rate and inflation rate can be closed? And if you, in the short term, have lower interest rate that goes into reproductive activities and you have a rev up of production, you are going to see more goods and services come into the market. The higher volume of goods and services into the market will drive down prices, and that will lead to moderation in inflation. So, and then the other factors are what the US used to bring back economic activity after the Great Depression. But for Nigeria's unique issue is about improving productivity, improving the volume of goods and services produced in the country. And you can't do that at the current higher interest rate. If you look at the productive sector of the economy like agriculture, manufacturing sector, they are all going through they are all at fasted one because they can't get access funding. Today, if you go to the market to buy money for loan purposes for this sector productive activities, you're going to get those at 25 to 30%. And no this sector operator can survive at such interest rates.
All right. Thank you so much for your time. We really appreciate this conversation. It's the first trading day post Tinubu's inauguration. Johnson Chukwu, market professional and group CEO at Carrier Asset Management. Thank you so much.